Welcome back. Average mortgage rates just surged to nearly a 9-month high to over 7% on Wednesday. Because of this, for someone looking to buy an average price home today compared to 1 year ago, it's going to cost them hundreds more per month. Meanwhile, housing affordability is very close to the worst on record because home prices are still up from last year despite these high rates. So in today's video, I'm going to share all the details. Plus, I'm going to share some more early indications of home buying demand so you can gauge which direction our US housing market is headed. With that said, I invite you guys to subscribe to this channel because I post frequent housing market updates so you guys can make a more informed decision about whether to buy or sell a house. And with that said, let's begin today's video. So I want to kick off today's video with a look at this right here because the yield on the 10-year US Treasury note increased to 4.082% on Wednesday. And that, by the way, is the highest rates since November of 2022. So because the yield increased by 3.5 basis points, that caused average mortgage rates on Wednesday to increase as well. According to Investopedia.com, as of August 2nd, the average 30-year fix for people with great credit is at 7.46%. Absolutely crazy. Also, according to the Mortgage News Daily, the average 30-year fix is at 7.13%, nearly the highest rates we've had since November last year. Also, for a 30-year fix for FHA or VA, it's around 6.80%. This is a fairly significant increase compared to 12 months ago because just 1 year ago, the average rate was 5.30%. That's an increase of 1.83 percentage points over the past 1 year. So I want to share the true impacts regarding how is this impacting current home buyers right now. So take a look at this. For someone looking to buy a $400,000 home, putting 5% down, based on your rate 1 year ago at 5.30%, your housing payment of principal and interest would be $2,110 per month. Now, fast forward to Wednesday's rates at 7.13%, your housing payment is now $2,561 per month, or an increase of around $450 more per month to buy that same price home 1 year ago compared to now. Something else definitely worth mentioning as well is that buyers' purchasing power has also decreased as well. So buyers' purchasing powers have decreased by about 20% from 12 months ago because your average monthly mortgage rate just increased by nearly 2 percentage points as well. So let me give you an example. Let's say you're qualified 1 year ago for a maximum loan balance of $400,000. Fast forward to today, because rates have increased by nearly 2 percentage points, that means you're going to qualify for about 20% less today compared to 1 year ago. Therefore, you may only qualify for around $320,000 compared to $400,000 1 year ago. That's number two. Number three is because rates have increased so much over the past 12 months, your interest paid over the life of a 30-year loan is so much higher compared to what we had just 12 months ago. So 12 months ago, your interest paid would be, for this example here, of course, $400,000, putting 5% down. Your interest paid at a 5.30% rate would be $380,000, just under $380,000. And that's approximately $162,000 more in interest paid over the life of that loan. So to summarize here, because rates went from 5.3 to around 7.1%, that means your average monthly housing payment on a $400,000 home, putting 5% down, is approximately $450 more per month. But on top of that, because rates did increase, your buyer purchasing power just decreased by about 20% as well. And also, to make matters worse, you're going to pay over $160,000 more in interest paid over the life of that 30-year loan. And that, my friends, is the true impacts regarding these high rates we have right now. So one thing I do want to share as well is this right here. This is according to the MBA, just posted on August 2nd. It says here that applications for home loans to buy houses and also to refi decreased by 3% from 1 week ago. So the MBA, if you guys follow the channel, you guys know where I'm going with this. The MBA breaks this down by their refi index plus their purchase index. Of course, the refi index is a measure of the amount of people submitting loan applications to refis, whereas their purchase index is a measure of people applying for home loans to buy houses. So, of course, it makes sense that the refi index is down by 3% from last week and down by 32% from 1 week ago or 1 year ago because rates have increased so much, right? But also their seasonally adjusted purchase index decreased by 3% from 1 week ago, and also it decreased by 26% from the same time frame in 2022. According to Joel Kahn, who's the MBA's vice president and deputy chief economist, he stated the following. Rates edged higher last week with a 30-year fixed rate increasing to 6.93%, leading to another decline in overall applications. He also says here the purchase index has now decreased for the third consecutive week now dropping to the lowest level since the beginning of June this year, and of course remains approximately 26% below last year's levels. Now, here's something they did not mention though, because their purchase index right now is at 154.1. This is the lowest pre-pandemic levels going back to the end of December of 2014. Back then, the purchase index was at 152.4. So in other words, home buying demand is still very, very low, despite the fact that prices are up compared to 1 year ago. And frankly, the increase in prices that we've been seeing this year is really due to a lack of housing supply and not due to a giant increase in demand like we saw in 2020 through the first half of 2022. Now, speaking of that, here's another indication of home buying demand as well. These are people searching for homes for sale on Google. So for the week ended July 29th, their index was 85. 1 year ago, it was 100. This means that more or less there's approximately 15% fewer searches on Google for homes for sale compared to just 1 year ago. That's that. But also take a look at this. This is the number of real estate showings across North America according to showingtime.com. So for the week ended August 1st, this year, it was an increase of 6.6% compared to the first week this year. So an increase of 6.6% in the number of real estate showings across North America compared to the first week of this year. Last year, this time, it was a decrease of 6.8% compared to the first week last year. In stark contrast, we saw a gain of 14.6% in 2021, and in 2020, a giant increase of 39.5%. Go figure why home prices increased so much in 2020 through the first half of 2022. Now, speaking of real estate showings, here's a new report from the National Association of Realtors in collaboration with Central Lock. And Central Lock is a lockbox company that measures real estate showings across the US here. It says here the lockbox are used in roughly a third of home showings across the United States. Foot traffic has a strong correlation with future contracts. Contracts mean a pending home sale, a measure of offers being accepted by buyers and sellers here, of course. So it has a strong correlation with future contracts and home sales as well. So it can be viewed as a peek ahead for home sales in 2 to 3 months into the future here. So when looking at this June foot traffic report here, here's what it has to say here. So home showings in the US were flat year over year with approximately 766,000 home showings for the month of June across the US. The pace of showing activity has increased compared to last month, which of course was May 2023. Now here's a look at the number of real estate showings compared to 1 year ago by region. It says here 3 of the 4 major US regions have posted a decrease in home showings compared to 1 year ago. So for example, in the Northeast, home showings decreased by 20%. In the Midwest, they fell by 3% compared to June of 2022. The West fell by 3%, whereas the South increased by 5% year over year. So I'm really curious what you guys think the rest of the year looks like regarding our housing market here. In my personal opinion, the increase in rates, again, over 7%, increasing to nearly a 9-month high, is very, very bad timing because in the second half, each and every year, our housing market tends to slow down. And of course, home prices tend to decrease as well. This actually happened last year as well, where rates were increasing to much higher than the first half last year. And that's one reason why the housing market was virtually frozen in the second half of 2022. So if I would imagine that, so we're going to see a lack of housing affordability coupled with a seasonal downturn. So it's going to be very, very interesting to see what happens for the remainder of the year. And of course, I'll definitely keep you posted. With that said, please comment below with your biggest takeaways from today's video. Hope you guys have an awesome day and look forward to seeing you on the next video.